Just this week in real estate, we saw inflation hit a 5-year low. We saw housing starts that are essentially just dropping off of a cliff. Businesses are closing across the nation. And all of this is leading up to a Bank of Canada meeting next Wednesday. Where are they going to go with rates? Let's dive in and discuss. Okay, off the top, we are discussing the inflation print that just came in this week. Inflation hit 1.6%, which was down from 2% the month before in August. Outside of the COVID shutdowns, that is the lowest inflation print this country has seen in 5.5 years, dating all the way back to February of 2019. During that time, the overnight interest rate was 1.75. That's 250 basis points lower than where we are today with the same inflation rate. Overall, shelter costs, which has been one of the main drivers of inflation recently, dropped from 5.3 down to 5%. Plus, the BOC, the Bank of Canada's preferred measures of median inflation, which strips out those volatile components, it remained unchanged from August. Okay, so that's stable, sitting at 2.3%. The most compelling element, however, of this low print is that it dramatically beat the market expectations, right? They thought it was going to hit 1.8%. It dropped to 1.6%, and everything is about expectations. This readjusted, of course, the market outlook on interest rate forecasts, which are now pricing in a 70% chance of a 50% cut or a 50 bips cut at the upcoming meeting on Wednesday. After that, they expect 25 bips cut at the December 11th meeting. Okay, so that'll end our year of 2024 with an overnight rate at 3.5%, if those predictions are correct. Looking out a full year now, markets are expecting the overnight rate to hit 2.5% by October of 2025. Okay, we're a year away from 2.5% overnight rate, should things stay as they are, which we know they won't, but that's the current predictions, okay? That's 1.75, 175 basis points lower during the next 12 months. Pretty significant. With that level of rate cuts forecasted, most mortgage brokers will be advising that if you're taking out a mortgage today, to go variable. And I've been talking variable for a while, and hey, proof is in the pudding. Just this week, one of my investment properties has been refinanced. I've switched brokers, I've switched banks, and I have gone variable. I ran the numbers, and fixed versus variable is definitely higher today. But with these forecasts, I firmly believe that variable will be the lower option as the years go on. So that's what I've done today. That's my advice for people in a similar situation. But of course, don't do anything on your own. Talk to your broker. Talk to us. Okay, moving forward. Where we are today at 4.25 basis point overnight rate, the Bank of Canada rate, it's basically 150 to 200 points above what they call the neutral level. Okay. And given our current state of inflation, current unemployment rate, the rate of insolvencies, the rate of businesses closing, the Bank of Canada appears to be lagging behind expectations, right? They lagged on the way up, and now they're kind of lagging on the way down. There's almost no reason that we can't expect a 50 basis point cut on the 23rd of this month. And it's encouraging news for those, for the front end and the mid segments of the Government of Canada's bond curve, right? Though it may place additional pressures on the Canada dollar. Well, additional might be a light word. I think we're going to see that dollar suffer pretty dramatically, unfortunately. Anyway, all eyes are now on the Bank of Canada, who will announce the rate cut on Wednesday. If I were a betting man, I'm just going to simply go with markets and keep it a little vanilla here. And I would expect a 50 bips cut on Wednesday. Ryan, I don't know. You a betting man?
It was funny. I was going to ask you that. I think there's so much at play right now. There's a lot of moving pieces, especially down south. We're a month away from a presidential election as well. And, with their jobs report coming out with, 254,000 new jobs down south as well, we're very much attached to their economy. And while I believe the Bank of Canada has every reason to perform a 50 basis point cut, just their historical, approach to this since they started cutting rates has been methodical and quite, understated. I just don't know if they're going to recognize the problems we see in the economy with the same level of perhaps problems that exist, or whether they have different data, right? So it's really hard for me to say. I would like to believe that they will do a 50 basis point cut. But much like you said, they're usually slow on the way down, and they were slow on the way up. So it's possible they'll miss the mark again. So I don't know. We'll see. We'll see. It's going to be a very interesting week, but I truly believe our economy and our country needs a 50 basis point cut, and we'll get into why. Let's start with housing starts. Housing starts are down 16% year over year nationally. In Vancouver, the year-to-date starts are down 23%. That's almost a quarter less homes than were built last year. And when you look to Toronto, it gets way worse. Plus, when you look at the 12-month rolling pre-sale condo sales, they have dipped to 6,000, an all-time low. Condo starts, which lag about 18 months, have started dropping rapidly as well. They've dropped a whopping 70% year over year, hitting 25,000 units, a 3-year low. This number could easily hit as low as 10,000 before it rebounds. And I don't think we'll see a rebound. It could be 2-3 years before this market actually recovers, maybe even longer. With no short-term relief in sight for the cost of constructing new homes, no new benefits for financing or things like that coming from the government, the pullback on housing starts will all but certainly create the accentuated housing shortage that we already have. And it will create more problems into the future.
So a topic that's come up quite a bit lately is there a housing shortage or is there not, right? We look to Toronto and we're going to get into their numbers shortly, but you keep hearing about listing spikes and high rates of inventory, especially in Toronto. They're experiencing almost a 20-year high in inventory. So is there a housing supply shortage or is there not? Well, in a slower market like what we're experiencing, this type of conversation becomes more frequent. How can you possibly say today that there's a housing shortage when there's thousands of homes for sale and very few people buying them, right? We see prices dropping, we see rental rates lowering, and so clearly there's no housing supply issue, right? Well, I think the counter argument to that is quite simple, right? We'll take the exact amount of homes in the country today and the exact amount of people today, and let's introduce an overnight interest rate of 0.25%. Suddenly there's a housing shortage again, right? Everybody rips to the market. Capital is cheap, and all of a sudden you've got investors buying, people are buying second homes, whatever. So just as we've seen over the last few decades, whenever we do see that cheap credit, then suddenly Canada is considered to be in a housing shortage, a housing crisis, if you will. But let's look outside of interest rates for a moment and kind of talk of a more exacting reference to the question, is Canada actually in a housing shortage or not? The best example that I can share is the housing units per capita, right? We're looking basically globally here. Like, how many homes do we have compared to how many people live in the country? The most recent data on this study is 4 years old. It's from 2020, and we all know how much population growth has gone from there and how much housing growth has not. But let's use the official data for now, and you can make up your own mind as to if the examples have gotten more extreme or not. In 2020, Canada had the lowest homes per capita within the G7. We have 424 homes per 1,000 people, or a 2.4 to 1 ratio. That G7 average is 471 to 1,000, which equates to a 2.1 to 1 ratio. So that puts Canada's homes per capita 11% below that G7 average. They stated that we would need an additional 2 million homes today just to catch up to the average amount. So to me, that speaks of a housing shortage overall, but also of a much larger issue, right? Because how can you have a housing shortage and an increase in supply at the same time? I mean, that points to the systemic problem of the cost of homes in Canada. And that's both the end user cost and of course, the cost to build. But food for thought.
Dan, was that official data? Was that Canadian data?
That's StatsCan, yeah.
I don't think they want to update that, if I be quite honest with you.
It will definitely trend to the darn side.
Yeah.
To the town side, excuse me.
No, that was spot on. But yeah. Well, and unfortunately, so will the state of businesses, because the state of businesses, if you're an entrepreneur in this country, you have the odds stacked against you. If anything, you probably believe that the government of Canada, with its capital gains position, doesn't even want you to sell your business, just rather you have it close it down. There's, they don't want you having investment property. They don't. It's kind of crazy, and the state of businesses here in Canada are in trouble. The number of active businesses in Canada has dropped a full 1% over the last month alone. That's the largest month-over-month decline since the pandemic. Active businesses dropped from 938,000 down to 929,000. And this was driven primarily by the construction business, shutting down a whopping 643 companies last month alone. A further indicator of the lack of future supply. You got to think, if these companies can't survive during the downtime and try and find some lots, try and find some inventory to build so that when the market does turn, they have something to sell, we're just going to be left with no product when the market does turn. And like Dan pointed out, that supply shortage will rear its ugly head when market conditions change. Far less developers are building, and construction companies continue to close down. And, you really got to think that federal Housing Accelerator Fund really hasn't done anything to support the construction business, right? I mean, we have 643 companies down last month alone, and this is supposed to be $1 billion fund to create more housing. What is going on here? It's just empty promises again. And what's more now is new businesses opening dropped to a 4-year low. So again, we're back to pandemic shutdown levels. And this is all being driven by the cost of credit. Imagine, not just the cost of credit, but a multitude of things, but primarily the cost of credit and sort of the cycle we've gone through, and a lot of political, in my opinion, a lot of political policies that do not benefit entrepreneurship. Imagine opening a new business 3 months into the COVID shutdown. That's where the new business mindset is now. It's terrifying. With fewer companies starting and existing ones closing at an alarming rate, the BOC will have to stimulate the economy here and try and get it back on track. That also needs to be compounded by political reform, especially at the federal level. It's obviously needed. What is currently going on in Canada is simply not working. And a lot of these companies, 643 companies, they probably won't start up again in Canada. They might go to a more favorable economic environment where they can survive, where things are maybe a bit more predictable. I just want to end one thing here. We're currently at a 4.25% interest rate. This is not the interest rate we need to stimulate business.
That's definitely something the Bank of Canada will be looking at, because they're already below the inflation rate that is the target. And of course, the number of businesses closing is definitely going to be on the forefront, because that's going to grind the economy and GDP to a halt and possibly go negative, right? They're trying to do everything they can to keep out of a recession. So at 4.25, they're in a tough place. And a lot of those business closings, I'm sure, was in Toronto, especially when we're talking about the construction closing. And I've got a bit of a Toronto update for you that kind of sheds some light on this, because Toronto ultimately right now, they're the epicenter of the housing correction. They saw new listings rise 10% last month, and it came in at actually the second highest August of all time for new listings. But check this out. When you shift to active listings, they're at 26,000 homes available in Toronto. That's the highest since the global financial crisis, the highest since 2008. Months of inventory hit a 20-year high for both single-family homes and condos last month at 4.5 months. If you strip that out to just the condo market, condos alone are at 7 months of inventory. This is clearly in a buyer's market. Price-wise, overall, Toronto saw about a 0.5% drop last month, and they're down 4.5% on the year over year. From the peak, though, from that 2022 peak, Toronto has seen a downside in prices to the tune of 19%. It's a big number, right? Let's be honest here. It's a huge number. And it's very interesting when you compare that to what's happening in Vancouver, where we've only seen a 7% decline since the peak of 2022. Condos in Toronto, again, they're down 7% year over year. With that rate of decline, it's accelerating, right? Toronto condo prices are already at a 3-year low. Again, let's contrast that to what's happening here in Vancouver, where if you can believe it, condos since the peak, the blow off top record prices, condos in Vancouver, GVRD as a whole, are only down 1.7%. I had to triple check that data today. I couldn't believe it. But yeah, so it's like, while Toronto condo prices are being decimated, GVRD condos have barely moved in prices. And do note when I say GVRD, we're talking about Whistler to White Rock, right? This is the whole real estate board included, because obviously there are some pockets that have been hit much harder than that. But GVRD as a whole, very stable. Now, do you remember the monthly cash flow index that we talked about sometimes, right? This is in Toronto. If you were to buy the average condo at the average mortgage rate and get the average rent, there was a time there rather, where if you were to make that purchase, you would be losing $1,200 a month cash flow. You'd be feeding your condo, your investment, $1,200 every single month just to break even. Well, condo prices, like I just mentioned, they're down 7%. And even with the rents dropping, that $1,200 a month is rebounded up to a negative $750 a month. Not that exciting, but if you take into account the principal pay down as well, you're almost back to a break even in Toronto. Still not super attractive, of course, and especially with the projected declines in prices. But you know what? There's going to be a segment of the marketplace, investors obviously, who are going to start looking at condos in Toronto again in the next couple of years as being a viable investment. Especially those who are savvy enough to look at the future completions and realize that by the year 2028, new condo completions in Toronto are going to be at record lows. And that'll probably start to create that supply issue again. And what happens when supply is considered low? Prices tend to tick upwards. Okay, so in 3 to 4 years now, you're going to start to see this mass supply of Toronto condos disappear and possibly go negative again, in the sense that they'll be very low and prices will tick up. Last thing here, mini market update for Vancouver, because as always, it's interesting, right? We're halfway through the month of October. What's going on? Sales for October, if they maintain their current trend, they're going to hit 2,850, which will be the highest month of sales for all of 2024 and will be the most since June of 2023. New listings are maybe a couple percent under last month, but of course, way more than last year, right? New listings will be 30% year over year kind of thing. Inventory, it's kind of just chugging along for the fourth month. It's going to wash out under 15K for the fourth month in a row. But price-wise, this one blew my mind. Yes, we're only 2 weeks in. We'll see how it washes out. But right now, median home prices are up 70K on the month, and they're only $5,000 under the all-time high. Double take on that one. Average is inching up as well. Average is up about 11,000 on the month. So October, understandably, it's going to be stronger than September. And then, of course, we have a rate cut next week, right? Probably 50 bips. And is that going to turn into maybe a bit of a spark in a November market, which we almost never see? I don't know, Ryan, what do you think? If they go 50, will we see a spike in activity till November, or is the year just done and everyone's basically waiting until the spring market of next year?
Historically, looking historically, it typically takes 6 full quarters for these interest rate hikes or cuts, to take effect. Are we starting to see the effects of sort of the last 3 interest rate cuts? I mean, even that's a bit soon. I think that there's a lot of things going on in the economy right now. We've got a political election coming up. We've got, a regional one here, anyways, provincial one. Then we've got a U.S. one, and then who knows how the federal election cycle is going to go here, with the Liberals losing a lot of internal support for the Prime Minister right now. So there's a lot of things that I think are on people's minds right now, and there's probably some hedging. But at the end of the day, I don't think, a 50 basis point cut will improve sentiment, and people buy on sentiment. The question is, how quickly will that sentiment move through the system? It's really hard to know. And so I do think that we'll see a 50 basis point cut. I hope, but I'm not so confident that it's going to be in time to create much of a fall market. And Dan, one last thing I just want to mention, because you made some really great points here about what's taking place with the Toronto update, and I just wanted to exemplify the fact that about 40% of Canada's total working population is in Ontario. And if you can believe it, as of August of 2024, the unemployment rate in Ontario is 7.1%. I just checked this out, and I'm telling you right now, that's recession level of an unemployment rate. And so, that might give the bank what it needs to quantify a 50-point cut. So if we see it, great. But I think there's going to be some time for recovery before we start seeing the market pop.
Yeah, who knows? Maybe there's a surprise 75, right? We were all surprised when they hit 100 bips on the way up. That was for sure.
Yeah.
Definitely remember that announcement.
Mm-hmm.
But either way, like if we're targeting, or if the bank's targeting 175 basis point of cuts in the next 12 months, well, you might be thinking real estate again. And if you are, we'd love to connect, right? Let's talk. When is the best time to sell? When's the best time to buy? Knowing this forward guidance that the BOC is essentially providing. You can connect with us by clicking on the Calendly link below. Let's schedule a time to talk real estate. We'd love to help and hear your story and see if we are the right team for you. So thanks as always. Make sure you get out and vote if you have not already. You're probably listening to this on a Saturday, last day to vote. And we will see the outcome of the election and the BOC rate announcement next week. Lots of moving pieces in real estate, especially in Vancouver, and we're here to help guide you through all of it. Have a wonderful weekend, and we'll see you here next week. Bye.